Hello traders, today is the 19th of February. My name is Neville Hornsey, market analyst YouTrading, and today I'll be reviewing the previous week. Okay, I'm going to start with the YouTrading.com Forex Heat Map. The markets are closed, but on Friday we ended with a weak euro and a very weak Canadian dollar. We saw strength go into the USD, the New Zealand dollar, and the Chinese yuan. On an economic calendar, I've highlighted the key points that I thought moved the markets during the week. So on Monday, the start of the week, we had FOMC member Bullard telling us that he still reckons we're going to get a 1% rate hike by July. However, he did walk back his comments on the inter-meeting rate hikes during that. So I don't think we're going to get more than the 4 rate hikes between now and July, starting with March, but doesn't mean that they're not going to carry on beyond July. Tuesday, PPI USD. So the US prices risen by 1% month over month. That's a big jump from the previous reading of 0.2%, and it beat market forecasts. UK CPI year over year came in just above expectations in the previous reading at 5.5%. Canadian CPI month over month jumped a good 1%. So the previous reading was minus 0.1%. This month's reading was 0.9%, so that beat expectations as well. US core retail sales and retail sales both surged higher. Obviously, the previous readings were minus 2.8 and minus 2.5%. We had a big increase in those retail sales month over month. And then FOMC meeting minutes on Wednesday. The meeting minutes, even though Bullard's very hawkish, these meeting minutes as a whole weren't as hawkish as expected. So that had an effect on the US dollar during the midweek. Thursday and Friday, no real scheduled sort of news, if you like, but the whole week was dominated by Russia, NATO, US, Europe, whether there will or not be World War III. Obviously, that's still ongoing. So the markets were driven by headline news, and we're probably going to get a lot more of that going into next week and beyond. Looking at the USA 500 on the active trader platform, this is the S&P 500. On a weekly chart, the dynamic support came from the 50 sort of EMA. If we were to sort of see a further correction to the downside, now 10% is a correction. So we had that pretty much into the sort of lows of January. A 20% reduction from the highs from here to here would be then into a sort of bear market. And if we look to a daily, the price is already underneath the 200 period moving average. If we look to the left, we've got this area here from about a year ago, which was a bit of a sort of basing before the jump up. Obviously, real test into the sort of 50 period moving average a couple of times. So we could get down to the 3,800. Another thing we should be aware of is a Fibonacci extension. So if we go from the all-time highs to this pullback to that high, that could take us down to the 1.618, which would be just above the 3,600. So we could be looking at somewhere between 3,600 and maybe a measured move of 4,000 here. Either way, if we go to the weekly, if I get rid of this and this, on a weekly chart, I can imagine the 200 period moving average rising into this zone. If we look to the left, we've got this candle here from 21st of March, 2021. That hasn't been tested that high. So I think we get a good 400 point drop still. Obviously, I don't want to see that, but if this Ukraine thing just carries on, then it could be a bit like when Donald Trump was basically doing the trade war with China. We had a big sell-off then. In this sort of period here, we could get a similar sell-off just because of this Ukraine thing going on. Looking at the German DAX, that's already sort of broken through the 50 period moving average on this weekly chart. There could be a bigger drop down towards the 200, down towards the 14,000 sort of level. They don't want to see war on European soil, but obviously there's going to be flows out of the euro, out of the DAX, because economic activity will just slow down. Obviously, if Nord Stream 2 doesn't come online, then that's going to keep European inflation going higher, and that would be bad probably for this German DAX as well. UK 100, momentum to the upside, price actions to the upside. However, we did take out last week's low, so we could be seeing a change. Obviously, the whole market is risk off whilst this NATO thing's going on. We could get a pullback at least to the 20-period moving average. Momentum generally leads price action higher. As long as we don't take out this significant swing low from January, then we've got a chance of these dynamic averages acting as support. Looking at the price of oil, hovering around $90, a bearish outside week. We saw that happen back in October 2021, also in July 2021. Both times the swing highs here created the sort of jump, if you like, off for a big sell-off. Looking for the 50-period moving average, that would take the price of oil down towards 76. If Iran get their nuclear deal signed off, then that allows oil to come back, from the sanctions. So that would see supply maybe overpower demand, and that's when we sort of see this drop off. USD, bulls are in control. 20, 50 are rising. 50 is still compressed underneath the 200-period moving average. If that crosses, then we might see some trend followers jump in, see the dollar rise up, see if we can get to the low of the May 2020 here, so around the $99. If that happens, I'm expecting it to be driven by the euro. Obviously, if there's conflict on European soil, people are going to remove their cash out of the euro, put it somewhere safe like the yen, and we're going to see a big drop down towards the 1.1. Talking to the yen, dollar yen here, bulls, gave up last week. We saw the selling pressure come in from the 116 this week, just gone. Friday closed bearish. We took out last week's low as well. So the flows going into the yen, into the Swiss franc, basically risk off. People are looking for safe havens to put their money. We've had this big run up. Rising channels generally break to the downside. I'm expecting to sort of see, a good test of the 20-period moving average on this weekly chart, maybe even the 50, and then we'll have to reassess, I guess, because we might have broken some market structure. So going back to the calendar, Wednesday, core retail sales month over month, big jump up. Now got advanced retail sales here in red. We can see that the base effects from the dip in 2020, during 2021, we saw the base effects just absolutely accelerate a lot higher. Since April 2021, retail sales, the rate of change has come down. We're not quite back to pre-pandemic levels, but it'd be good to see, this rate of change dropping still. Hopefully that means CPI itself or PCE, just drop. For me, that's been driven by these oil prices. Like I just said, we just had an outside week, so I'm hoping that oil prices do come down. That will just ease the pressure off inflation. And even like here, we've got PCE. This is core PCE, so it's minus that food and energy, but it's still been driven a lot higher. It's still going along with the price of oil. So for me, all inflation is being driven by these oil prices, whether or not the price that they used is actually taking into account oil and energy. Another thing that could be driving prices are obviously rates. The Fed haven't raised their effective fund rate yet. It's still pinned here towards zero. They're obviously going to try and push it up by a percentage point by July. The market's already started pricing that in. They started pricing that in a long time ago as they saw inflation rising. This is the CPI, this time in red. The market was pricing in using the sort of benchmark 10-year yields here. The Fed need to catch up. Obviously, we don't want to see the Fed raising rates to the point where buyers, retail sales and things like that get priced out and they just refuse to pay the higher prices. Generally, that leads to a recession as there's a big sell-off essentially. So we don't see that happen. But like I said, if prices are to come down, as price action is sort of suggesting here, then fingers crossed it's not a recession. A recession would be 3 months, so another month if you like, of down declines. We don't want to see that continue into another quarter. So if we do get a sell-off, I'm hoping it's a big, quick sell-off and then a bounce. And fingers crossed, if we do get a chance to get in, it gives us a good level to get on. We don't want to see it coming all the way down here towards 3,000. All right, next week, probably going to be more of the same. It's probably going to be a lot more Ukraine, Russia, US rhetoric, news-driven headlines, and we'll probably see a lot more flows into the yen and into the Swiss franc. All right, I hope that makes sense. Hope you had a good week, and fingers crossed for next week. Yeah. All right, speak to you then. Bye-bye.